Fantastic. So let's get started. Thank you very much, everyone, for joining in. I'm Rajiv. I'm a managing partner at Orias, an early stage fund with 100 plus startups and 3 unicorns. Look forward to this session. Welcome. I'm very excited to be doing this session with Tony. Tony is the editor of the Morning Navigator newsletter. He founded the independent research firm TG Macro in 2016. Tony got an introduction to trading at a very young age at the family dinner table from his dad, an OTC counter trader for 30 years at Dean Witter. He's a bit of a rock star and looks it, as you can see, Tony Stark Oops Greer. We marvel at your good looks. And after graduating from Cornell, Tony started off with the Forex desk of Sumitomo Bank there on the 107th floor of the World Trade Center. We need to talk about that, Tony, at some point in time. From there on, he went to UBS, where he started trading commodities and currencies and provided liquidity to a lot of big banks. He managed the Gold Book and the Goldman Sachs Commodity Index for J. Aron and Company, the commodity trading arm of Goldman Sachs in the late 90s. Tony is one of the few people who have directly managed institutional investors across 4 different asset classes, Forex, commodities, equities, and by proxy bonds. That gives him a very unique perspective into the world of investing. I've always been impressed with his top-down approach to markets and commitment to the commodity sector. So I'm going to do the prudent thing here. So the one other thing is basically that the fact that he's a risk manager, and in his newsletter, he clearly articulates how to manage risk, is a significant differentiating factor for his Morning Navigator newsletter. As a prolific creator of content, he's a great storyteller as well, right? So I'm going to do the prudent thing, as I said, stay out of the way, hand it over to him for about 30 minutes for his insights and his slide deck. And after this, we'll move to the Q&A session, picking from the audience suggested questions already collated and perhaps new ones raised, which I'll request Tony to comment on. So please, to all of you there, that are listening in, type your questions on the chat. I look forward to a productive 60, 70 minutes. And over to you now, Tony.
Rajiv, thank you so much. That was a tremendous introduction. I'm absolutely honored, and I'm literally humbled by the Tony Stark comment. I thought amazing. I wanted to say thank you so much for me to present my ideas. I work hard daily to markets and apply my study of letting the markets tell me where they're going. If Rajiv would flip to the second slide there, I like to tell everybody that I'm a trader, not an investor. And that's a Paul Tudor Jones quote, but that is the essence of how I approach markets. I start off essentially, moving money towards positions that I think are going to fit in the macro picture and perform. And I start them off as short-term trades. And on occasion, they turn into investments when they go my way for a long time with a trailing stop type of principle. But I am generally of the mindset of I want to buy something here with a very specific target, end date, and time to sell it. And usually when I get into positions, I am definitely not expecting to hold on to them very long, because I'm still a trader that's probably right only 55, 60% of the time. I've just managed to figure out how to capitalize on the trades that I'm writing. So that's sort of my essence as a trader. I have an interesting background story that I'd like to share just for 1 second before I go into my discussion of what's going on in the markets right now. I had a very interesting experience in my career where, as this commodities trader at Goldman Sachs, it was the mid 90s. I worked there from 94 through 2000. And I was investing in technology stocks at the time while I was there trading the commodity book. And at the time, oil was 10 bid at $12, and it was a good business, but not that many people were actively trading it or speculating in it. Gold was 250 bid at $400. Not a lot of people cared, I'll tell you that. And at that point, I was investing in these technology stocks that were taking off like, wildfire. And I was always scared buying them because as an employee of Goldman Sachs, I had to hold them for 30 days. And I was always afraid that I didn't know if I wanted to stay in them for 30 days. And during the tech boom, it turned out that 30 days after your purchase, you could have been up 50, 60, 70, or 100%. And so at that point, as a momentum trader, I'm adding to these positions. And then the overlay is I get pretty successful at trading these .com stocks into the .com bubble. And in December of 1999 or so, I decide that in 2000, I'm going to leave my seat at the commodity desk at Goldman Sachs so that I can pursue this technology boom that's taking place. And I finally sat down to trade them in March of 2000 with the NASDAQ at 5K. And basically, as we got our funds started to trade, the NASDAQ tumbling down from 5K. And I looked over on my screen and a 10-year commodity boom started on the Goldman Sachs that I just left. And so I figured out that the only way that I could survive after making this incredibly, at the time, very foolish decision to leave the firm, the best way that I could survive was to pivot into my equity trader book of in my network and start teaching them what was going on in the commodity world, while oil and copper and aluminum were going straight to the upside on China buying in the first commodity super cycle. So I just wanted to give you that background because I've got some really good life experiences that have taught me a lot about following markets, about, you know, booms and busts and things like that. And it's really played out directly in my life. So let's go into my thoughts here. Rajiv asked me to talk about the administration situation and the change here. And, you know, I don't mean for this to be political. I just kind of tell it like it is. You know, we had Trump in the White House that was very much America first. He put sanctions on China. He was a strong dollar admin, whereas the Biden administration seems to be a little bit China friendly and okay with a weaker dollar. You know, Trump was all about cutting taxes and regulation. The difference is Biden is about stimulus and fiscal spending. And I think that is a little bit how we're going to play into the markets here. This is another way that the change plays into the markets. You know, President Trump rejected climate change. I think the notion of it, I think he rejected the whole theory of it. And while I'm not a climate change denier, it was interesting to see how that played into his policy. It was a little bit of an eyebrow raiser when the whole world is sort of accepting that there is some form of climate change taking place. So now we've got President Biden in the White House that is following right up on that theory and installing a green economy. So that's going to have a tremendous effect on commodity prices, stock prices, and what's going on in the markets. So that's going to play into what we discuss in a little bit. President Trump was about an industrial renaissance in this country. He loved manufacturing. He loved building. He loved construction, right? He supported all those industries, cut regulation down as much as he could so they could flourish. And here we are, you know, with the Biden approach, and he is going on this net zero emissions by 2030 approach. And that's going to be interesting to see him implement that. What's very interesting to me that has played out sort of immediately into the Biden regime is we had equities probably priced in a 15 or 25% volatility premium with President Trump in the White House. You can see the VIX clear as day was basically bottomed out at 20 and traded in a range between, say, 20 and 35 during the Trump administration. I think that plays a lot into the fact that he would wag markets from his Twitter account. And, you know, you had to be on your toes at all times with President Trump in the White House, who was up at 5 o'clock in the morning moving markets. So now that we have Biden in the White House making no comments on the stock market whatsoever and very little communication on what he's doing at all, now we've got a very low equity vol regime. And that's very interesting to me because it gives you opportunities to hedge against things like we saw yesterday, which was the market selling the fact on a FOMC meeting. But we're going to get to things like that in a minute. I'd like to proceed to the next slide because I think the most important thing is the overlap, you know, between Trump and Biden is the Federal Reserve, right? And so that's why not a whole lot has changed for me in terms of pivoting into the new administration, right? We're pivoting in with eyes open, and we're going to look to see how the world is changing and what people are doing in reaction. But the bottom line is that we've got Powell and Yellen at the Federal Reserve and Treasury. And I think it's very, very relevant that Janet Yellen was inserted to the Treasury as another familiar face providing stimulus and providing calm to the markets. And I think that was very much done by design because it looks like we're going to be on a very steady path in the Biden administration of stimulus to solve problems, helicopter money to help the people, and different things like that. And probably a lot of, easy money and more liquidity from Jerome Powell. So that's what I'm seeing, a lot of the same. Let's go to the next slide, Rajiv, slide number 5. This is really important. You know, I operate from a basic tenet that we are deflating the dollar by adding to our debt load and by adding to the Fed balance sheet. If you ask me, as we approach 30 trillion, you can see how we just had a big leg up in our debt to address the COVID lockdowns and to address the great financial crisis from 2008. And now we just had another leg up here to address the lockdown damage. Excuse me, I said that backwards. First, we had a big bump up in 2008 and then another leg up to address the lockdown damage. Then last year, to me, the biggest headline of the year in markets was the Fed doubling their balance sheet basically on one print to adjust for, you know, the weakness in markets. That dynamic that they set up to adjust to support markets in an emergency situation, that buying of 120 billion in treasuries every month, that plan is still in place now. So this is playing into the inflationary scenario that we're seeing play out on the screens. We're seeing it in commodity inflation. We're seeing it in headline inflation now. And I think it very much has to do with the broad weakness of the dollar alongside a lot of other bottleneck and specific commodity issues that are going on. But this story to me is something that we can't forget about, because when I think about the Fed balance sheet going from 4 trillion to 8 trillion, what you have to think about from there is what is next? And the most valuable thing for me to think about in terms of what is next is how are we going to address any other future market episodes or economic weakness? And the economic weakness is going to be addressed with more stimulus that's going to add to debt. And any emergency situation in the markets is probably going to be addressed with a bigger set of emergency asset purchases. So to this day, we're probably seeing a lot of inflation because the Federal Reserve continues to buy 120 billion in treasuries a month, with the S&P at 4,000, with PMIs in the mid 50s or close to 60s, with 6% unemployment, and with headline inflation starting to show. So this is very interesting and something that probably is going to be something that affects markets for time to come. And if you go to the next slide, Rajiv, this is posted that I have on my screen. And I try to be a little bit relaxed and candid with you guys because that's the vibe that I got from Rajiv. And I want to just tell the right narrative here. And I do have this posted sitting up on my screen that says the Federal Reserve is inflating assets. If you own assets, you will survive. And if you don't, you will have a problem, because that mode is what stops me from shorting the S&P, from shorting hard assets, and really approaching this inflation trade for what it is, for the Federal Reserve inflating assets and trying for a trickle-down recovery theory. So I keep in mind that I need to stay long assets. Rajiv asked me to speak a little bit to dollar inflation. Exactly. Next slide. How dollar has been affecting commodities. And I just chose Aussie dollar strength so that I didn't have to invert a dollar index chart, because that confuses people sometimes. So we're looking at an Aussie dollar versus US dollar chart in white versus the Bloomberg commodity index in red. You can hear you can see the clear relationship, the spike down in the March lows, the recovery from there. And so this is the effect that we're going to continue to see. And I think that, I watch the Aussie dollar probably primarily as the driver of metals prices. When you see a strong Aussie dollar, you usually look over and you see iron ore rallying and platinum rallying and gold rallying, et cetera. So this is the type of relationship here that I'm looking to continue. As you can see, Aussie dollar has leveled off. So the dollar weakness has leveled off. On our screens, we've got a huge dollar rally going on right now that is sort of knocking the metals complex back on its heels. I'm not really shocked that this is taking place at this level with the Aussie dollar up here around 75.80. As you can see, that's the level that the Aussie dollar fell from in 2016-17. So it doesn't surprise me that this is the level that the Federal Reserve and China have picked to sort of say, okay, this is our line in the sand with the commodity prices. It feels to me like the Federal Reserve and China are engineering this dollar rally here that's putting metals and especially gold back on its heels. I think Jerome Powell's way of saying that the inflation is transitory is going to be by saying, well, look, gold was 1950 a couple of weeks ago, and now it's 1800. So there's really no inflation. So I think that that's how the Federal Reserve is going to try to play that via a recovery with controlled dollar demolition. When I go to the next slide, I wanted to highlight some of the market-based inflation expectations that I have been following that have been driving either with headwinds or tailwinds from the commodity trade. And if you look at the break-even 5-year, that break-even 5-year is a measurement of the 5-year yield plus an inflation-adjusted 5-year security. And you add those two together and you get where your break-even is on a 5-year bond. So as you can see, we had a spike down to 50 basis points on the lockdown low, and a tremendous spike in the span of 1 year to 250 basis points, 2.5%. That signals inflation is on the way. It signals economic uptick. Most importantly, if you are sitting here at the trading desk real time and you're watching the break-even 5-year on a very short-term chart, a 5-minute, 10-minute, 30-minute, rather than this big 30,000 foot up view, you will see directly how the market is perceiving inflation and directly how it is playing out on the screens in the dollar and in commodities and in equities. So this is one of the things that I've been using as my barometer to stay in the inflation trade. I want to go to the next slide and talk about ESG and the green economy here, because I included there's some links in this presentation in the PDF, Rajiv. You can click on joebiden.com. That will take you to the actual clean energy revolution plan. I've got a couple of the bullet points here, but I have a picture of Joe Biden and Larry Fink up there because this is kind of a combination act between the two of them. If you think back to Larry Fink and some of the comments he made in the beginning of the pandemic, he said he called it an existential crisis, a reminder of our fragility. And he's putting the threat of global climate change more to the front, to the front of the screen now, because like the pandemic, it will alter all of our lives. So this is, the head of a $9 trillion institution, weighing in on the perfect storm between the pandemic and the opportunity to enter a green economy to fight climate change. And so this is sort of pivoted comments like this, notes by the S&P that have come out where they've sort of put big oil on negative watch due to climate risk. They know that sector faces tremendous they face tremendous challenges with the Biden administration in office, and that could potentially put pressure on their profitability. So when Standard & Poor's comes out and says things like that, when the central banks form a network of central bankers and supervisors for the greening of the financial system, not only does my head spin around counterclockwise because I'm wondering what the Federal Reserve is going to do to address greening of the financial system, but these are the things that make you realize that the Federal Reserve is really into building room and reason to adjust markets as they see fit. And whether that's keeping rates low, keeping the liquidity spigot on, when you try to employ things like zero emissions by 2050, when you rejoin the Paris Climate Agreement, when you start a $400 billion clean energy innovation investment and try to put on a clean technology through the economy, you're obviously going to have all kinds of trickle-down effects in financial markets, commodity markets, et cetera. And this feels like this is by design, and this is what's going on during the Biden administration. It seems like this administration, we've seen cyber attacks and we've seen all kinds of bottlenecks. And there's no doubt that you can draw the line that these began after Trump left office. So these are things that we've got to get used to during the Biden administration. They play into the tightness of the commodity trade. They play into the rising rate story that I've been trying to latch onto, even though rates have paused for now. But if we go to the next slide, you'll see that there are also a lot of skeptics to the green movement. And I happen to be one of them. That's why I raised his hand next to the skeptics. If you click on an exercise in magical thinking and give that document by Mark Mills some time, there are a plethora of carbon-based data that really explains how powerful fossil fuels actually are, and unfortunately how weak wind and solar actually are in terms of their ability to transmit power. So, you know, when you start thinking about things like it takes 100 barrels of oil to make one battery large enough to store the energy of 1 barrel of oil, you start to say to yourself, what are we doing here with this green movement? When you've got former BlackRock CEOs, portfolio managers like Tariq Fancy, blatantly admitting that he left that space because he was really, you know, figured out that it was a hopeful idea and something that was being sold to the public, I get very skeptical myself, because this is an insider portfolio manager that's looking at all kinds of credits and equities, and he's deciding that what they're forcing on the markets is unnatural. So I'm a big proponent of Tony Dayton, who is sort of you know, a gold-based you know, currency guy, and you can get a great insight into him with that Grant Williams podcast that I linked to there. But he's a believer that the word sustainability itself doesn't mean anything. And what they're trying to drive sustainability toward is this sort of lofty goal that is really just an excuse to change our behavior for using natural resources, energy, and all kinds of other commodities here in the country. If you click to the next slide, I feel like I've outlined what the opportunity is really well. To me, the opportunity is to invest in fossil fuel stocks. You know, this is the energy as a percentage of the S&P. As you can see, there's been a clear path lower since the great financial crisis. You know, that has to do with the takeoff in technology, et cetera, because pretty much from there was, you know, the birth of this really accelerant, easy money rally in technology that's led the FANG stocks to sort of lead out in front. And we've got an opportunity now to invest in fossil fuel companies when they are the smallest percentage of the S&P that they've ever been. So this is the opportunity that I've been focusing on. I focused in and dialed in on stocks like ExxonMobil and some of the refiners when oil was having that episode when it traded into the negative territory. And I knew that it's, you know, it was very interesting to me to have people calling me during that episode and saying, is gasoline at the pump really going to be free at some point? And that's when you realize that, you know, the prices on the screen are not going to agree with the real world for very long, and that these fossil fuel investments are probably going to be the ones that pan out while they're being thrown out like the baby with the bathwater, like Exxon at $25 or $30 at the lows. So we tracked those stocks during the lockdown plunge in oil. We bid for some of them as cheap fossil fuel companies. And now, as that story and narrative has evolved, the price of oil has, you know, gotten back on its feet into levels that I think are more balanced in the markets and more sustainable. And you've got the equity prices coming off the lows. Most importantly, companies like ExxonMobil are pivoting to service the clean energy, so with carbon capture and storage. So now they're opening up basically another vertical, saying, if you guys want to store carbon dioxide underneath the Gulf of Mexico, we've got all the equipment to do that. So I think it's interesting that ExxonMobil pivoting into the clean energy movement is likely going to be a Harvard Business School study for years to come, because I think this is going to propel them through this crisis for fossil fuels, and they're going to come out a winner on the other side. You know, when you take a step back and look at the XOP on the next slide from 30,000 feet up, you know, over the last 15 years or so, you can see how the XOP, and this is the basically exploration, production, refinery, the everything energy ETF is XOP. So if you see, as you see here, it's got a nice little cut bottom on it down to 50. We recovered to 100. And now it looks like we can break back into the range that this XOP has been trading in for the last decade or so. And that's been my contention that we're going to see happen for several months now. I hope everybody's okay. We're going to go on to, you know, I figure we'll do questions at the end. I wanted to go into the next slide now. Rajiv asked me to touch base on gold versus crypto. And I hope everybody is okay with this, because this is a goofy slide. I wanted to express what I felt about it in a tweet. So I posted a tweet that I tweeted on January 8th because I literally could not believe my eyes that financial participants in the market were buying Bitcoin at never before seen prices of 40K and selling gold at 1850. And it was very clear to me at that point, from the time that I posted that, that somebody was inhaling Bitcoin to inhale it, and somebody was selling out of gold to cut their exposure down. And so from that point, you'll notice that gold ETF, the total ETF assets in gold peaked just before that at around 110 million ounces and declined to about 100 million ounces over the next 5 months, takes us to where we are now. Over that period of time, obviously, we saw Bitcoin explode from there. When I tweeted this, in hindsight, as I look back on the timing when Tesla bought Bitcoin, that was actually Tesla buying Bitcoin up through new highs in January, and somebody else that I heard about selling gold. So it was a coincidental thing, but there was clearly money going into the crypto markets and out of the gold markets. So I posted that goofy tweet with this goofy picture because I literally couldn't believe my eyes. And I'm just trying to share that perspective with you guys, that for someone that's 50 years old, seeing them buying this cryptocurrency to new heights and sell gold at a time when I think that it's really, really beneficial to own gold, I could not believe my eyes. So I posted something like that. In a chart, if I go to the next slide, and we're going to talk about the principles in a minute, but what went on in crypto is we created a set of sentimental tops that was not to be believed. Usually in a security, you can follow a bull market, and then you will see a big print that is clearly as good as it gets for that security, for that stock, and it's usually the high of the move, and then things settle back into a range from there. Well, Bitcoin, being the sort of, magical crypto internet money currency that it is, managed to put in no less than 5 sentimental tops, in my opinion. We saw Tesla, a huge corporation, buying $1.5 billion of Bitcoin. We saw the Miami Heat rename their arena after a Bitcoin exchange. We saw Beeple sell a JPEG as a piece of art for $70 million. We saw all of the Bitcoin hodlers put laser eyes onto their Twitter avatars because they were getting greedy at the price at 65,000, talking about it going to 100,000. And then finally, just like every other market, just like at the end of the commodity super cycle, there was the Glenview IPO, the Glencore IPO at the very top of the super cycle in commodities. At the very top of the super cycle in Bitcoin, we had the Coinbase IPO. And as you can see, that came out at the very top of the move. Sentiment finally crumbled. Everybody in the currency is long. And we had a big adjustment event that took it down to a range now between 30 and 40K. So in conversationally, what do I think about Bitcoin? I do believe that it is elbowing its way into the picture as a inflation hedge. It is elbowing its way into onto the macro trading desk, saying, I'm something that institutions are going to pay attention to. And, Goldman Sachs offering all kinds of services now on their crypto trading desk is testament to that fact that, the intellectual capital and now the corporate capital and investment capital that has moved towards Bitcoin is undeniable. So this is, to me, is a sector that has to be, paid close attention to and revered. The problem that I have with it is, for me, gold is the store of value. I prefer to have a lot of my assets in cash gold where I can, and then take cash out from that and deploy it where I like to deploy it. So I'm comfortable with my money in precious metal, in gold. I think that a lot of people that have caught on to the physical trade and have purchased physical precious metals like me, there's something that we like about being able to hold on to that value in our hands, right? This is something where when the lights go out, if there's a flood or a fire, we can hold on to our gold, stare at it, and know that we can come out of the other side with some kind of a valuable asset that we can use to recover from whatever it is that we've been facing. Bitcoin, when the lights go out, understandably, you can't use gold or Bitcoin when electricity is dead and an economy is shut down. But when the lights go out, you can't see your Bitcoin and you don't know it's coming back. If there's no internet connection, there is no Bitcoin. And if you can't get back to an internet connection, although you may be able to store them on your physical wallet, you will have no use for that Bitcoin. And so for me, you know, while if you've seen those memes on the internet where they like to trash gold because and trash cash because those can't be used in a, you know, when the lights go out or an economic emergency either. For me, I still have more comfort being able to stare at that thing, at that asset, and know that it is with me at all times. So that's the difference to me between gold and Bitcoin. And like I said, I do think that it's going to find its way into the investment environment. I think that one of the best features of it is the non-fungible token feature. As an investor and collector, I think the fact that you can sort of, you know, audit, you know, the veracity of something and the custody chain is the most valuable piece of technology associated with maybe even probably maybe even Bitcoin, cryptocurrency, maybe the whole thought of the most valuable thought to me is this audit trail of the non-fungible token. So that's what I wanted to express, and that's my view on gold versus Bitcoin. If you go to the next slide, Rajiv asked me to talk about post-COVID investing. And I really, for me, it still goes back to that. If you own assets, you're going to be fine, and sort of keeping me from shorting trades and shorting hard assets on the screen, because I want to play post-COVID investing from the long side. And the reason is because I gave up a long time ago of reading the newspaper and reading books and reading the real-time news and deciding what my view of the world is and putting on trades based on that, and then hoping that the world comes around to agree with my view. I've abandoned that type of trading a long time ago. What I do is I look at the markets and I look and see what's performing, and I figure out what's trending from the bottom left to the top right of my screen, and I figure out how to exploit things that are trading in that direction. And if you go to the next slide, Rajiv, I've got the performance of, you know, basically the top performance test about what's gone up since the March lockdown lows. Now, as you can see, bank technologies have been out in the front in the equity index regime. That speaks to, you know, the obviously necessary need for everything tech when everyone is locked down and very little need for anything else. So these are big givebacks off the highs. FANG was up a lot more than that, and it's backed off. NASDAQ was up a little bit more, and it's backed off. But it's indicative of what's going on under the hood in equities, if you will. Then I look at sort of in commodity macro space in orange there. Bitcoin, even at 30,000, is up 500% since the lockdown lows. So that's something that we should pay attention to. Obviously, oil is the big, is the other next big mover there, coming out of a trough. I think it was priced to about $20 at the bottom of the lockdown, up 250%. But this sort of tells the story to me about the sectors of the economy, the sectors of the macro world that we should be pursuing. Copper, silver, Bloomberg Commodities Index, Bloomberg Commodities Grain Subindex up 50%. Gold doing poorly, up 60%. Maybe that's not the best inflation hedge. The dollar index down 9% from 99 to 91 or so in a big retracement rally now. But I think that as we come out with more headlines about stimulus and endless accommodation, I think we'll get the dollar to turn back south again. When I look at the sectors of the markets that have performed the best, you've got solar, which is massively off its highs, still up 200%. Metals and mining, home builders, energy, transports, materials, consumer discretionary, and then financials and gold miners. Actually, I flipped those by accident. Consumer discretionary should be at the bottom. Financials and gold miners have still been performing. So this is how I take a look at the world and say, okay, this is what's going on since the lockdown. Let me see what I want to be in and start charting these sectors. And if you go to the next slide there, I try to put some of my top 6 picks, if you will. I think slide number 17, Rajiv, you skipped 2 there. Let's go back one.
Sorry.
Yeah, my number 1 pick, I've been focused on oil markets. Crude oil is better buy at $70, $35 for what's going on in the economy and the oil space, specifically going into backwardation with spreads tightening. up year to date of 50%, and I think it's still in good shape. The next slide, Rajiv, shows a little indication why the curve is very steeply backwardated today versus 1 year ago where prices were lower and it was in contango. This type of structure gives me confidence to stay in the markets. Number one, it also gives me a positive carry on being long crude oil. When you're long, you roll into a cheaper contract and improve your average. To go to the next slide, I've been exploiting the oil and gas market because it's so cheap. XOP, these are some of the names in, oops, that looks like those got switched there. I unfortunately left the XME names on the XOP chart. That is my mistake. The XOP is made up of the big oil companies, ExxonMobil, Chevron, then the big oil services companies like Schlumberger, then the big refiners like Marathon Petroleum, Valero, and it covers the wide section of the energy space. What's really interesting to me about the refiners in the energy space specifically right now is that you will see, if you chart refinery utilization, you will see that as refinery utilization grows back to the pre-lockdown levels and we start burning more gas, the refiners have in kind picked up and started rallying. So that's the third leg of the equity of the energy trade that I think get going, that started going now as the refiners. Up 66% year to date, and not backing up much. If you go to the next slide, Rajiv, please, XME. This is the metal space that I've been trying to exploit. Very interestingly, it double bottomed in 2015 and 20. It's breaking up through this really important level here. This is your steel companies, your metals and mining companies, your gold miners, your aluminum miners, and something that should perform really well in a controlled demolition of the dollar to try to support the risk complex. So I think XME is going to be one of the best performers going forward. I have latched on to this natural resources ETF for my subscribers. We bought this a couple months back. It's up 34% year to date. This is a great cross section of metals and mining and energy, and I think a great play for if you want to just stick to pure natural resources plays. My last pick, my next pick is the home builders section has taken off. This is both the retail and let's go one more slide. Right. The retail sectors of Restoration Hardware and Williams Sonoma. I like this ETF because of that retail exposure that it has in it. I don't really invest in a lot of retail stocks, but the ones attached to the building sector have been on fire and on a tremendous bull run. So XHB, the home builders ETF, gives me some exposure to those. It also gives you exposure to the nail bangers, I call them, the home building companies that are out there building homes across the US that have got work on their pads as far out as they can see. So that's why these home builders have been rallying with tremendous, tremendous confidence in the space. I see a massive secular change here in the country of a lot good. We've got a lot more people working from home. We've got a lot more people putting money home office, home living, because there's more time there, and all of that unbelievable home builder rent.
Sorry, Tony, could you come a little closer to the mic? The voice is getting a little interrupted. Sorry.
Can you hear me okay?
Yeah, now it's better. Thank you.
Okay. If you go to the next slide, Rajiv, sorry, my other client. Rajiv, I've got BCom Grains is the next one. You look at this trend line that looks like it's breaking to the upside. We could potentially be coming out of a 30-year bear market in grains. I could see it happening as relationships between grain trading countries change, i.e. between the US and between China and Russia and Brazil. This could tighten up the supply chain. Currently, we're facing bad crop conditions in Brazil, not very good crop conditions here in the US, and we're seeing massive buyers from China and also India, which is interesting. I think that this is going to be a secular trend change. It seems like the time is right while other commodity inflation is taking place, while the oil markets back off, while the dollar is weak, metals are strong. I think that a lot of follow through investment. And to go to the next slide, I've chosen to express that by buying DBA, which is the Invesco Deutsche Bank Ag Fund. They have long corn, soybean, sugar, cattle, hogs, cotton, all kinds of things filter in the grocery bill that at this point are probably up quietly 20 or 30% since the lockdown lows and likely to go higher. This stabilizing type of inflation, food inflation. And so if we can in any way hedge our lifestyles or portfolio against that, I think that being long physical commodities in some way, shape, or form, especially food-based commodities, is going to be an important hedge to have on your books. And so I wanted to sort of stay on our timing there, Rajiv. That takes us right to about 8:40 in our last slide. That was my last pick. And so we can go over now a little bit more granularly sectors, questions that you want. And I hope that I've covered the material that you asked me to cover to your satisfaction, quite honestly.
Thank you so much, Tony. I think that was superb. I think I love the way you took very strong stances. It reminds me of another Stark, of course. So, but nevertheless, I think that strong stances, I think, is very powerful because we are now setting up for a set of questions coming out of here. So I think the first question that I would have is, we just had the Fed day come out, and let's start off with inflation, right? The Fed's view, as I understand from yesterday, is that the reopening trade is creating a demand spike, leading to a mismatch in supply and demand. Their view is that those transitory factors will eventually subside and the rate of inflation will slow down. What is your thought process on this? I mean, do you agree, or do you think that this is going differently?
Well, what I see developing in the market, Fed's transitory versus people that are coming out vocally that think transitory is crazy and dangerous way of approaching this. On the list of people, including myself, that think transitory is not the right approach to this are Jamie Dimon, Paul Tudor Jones, and I forget his first name, Mr. Weir, who is the CEO of Trafigura, the biggest commodity trading shop in the world, right? I just listened to, there was a Trafigura conference call, an earnings call that I listened to that was absolutely astounding to listen to. The CEO basically said that he could see a 10-year bull market in commodities ahead of him. They've seen tremendous, renewed, new client interest in the metal space. They see the green economy driving for metals, energy, and all kinds of rare earth and difficult to acquire base metals, if you will. And they also said that they don't think that the economy is ready for the full electrification of vehicles. So I try to listen to the people that are in the actual trenches, Rajiv, rather than, sort of impose my view on the markets or the world. But I tend to go along with people like the CEO of Trafigura and Paul Tudor Jones, who are saying that, now is a really important time to hedge your portfolio against inflation. In the big picture, the big plain vanilla, slow moving funds here in the United States are still largely positioned for massive liquidity, zero interest rates, commodity deflation, transportation deflation, debt deflation. And so this is how their books with billions and trillions of dollars are positioned. And I think that as the world changes before our eyes, that they're going to have to pivot into more inflationary type of book, where I think that they're going to have to sell some of their, long-held technology positions, some of their legacy technology positions. Because when you look at the world very logically, how is it going to get any better for Amazon than a global lockdown? How is it going to be better for Facebook than when everybody is locked down at home bickering about COVID and vaccines and everything that came with this episode? So, that just logically to me matches how the stocks sort of put in a top, and technology now has really struggled to perform this year. It just picked its head up as yields backed off in the last couple of weeks. But if we were talking about the subsectors of technology 2 weeks ago, we would have been talking about sectors that were flat to down on the year. And this is with XME up 45%, XOP up 65% on the year. And I think that
as you start to register more and more months and years of the markets doing this, where, oh boy, we've got a copper rally through 10K. We're going to start with the green movement that's going to basically take 10x our copper consumption. We're going to start that consumption with a very steeply backwardated copper curve, which means that supplies are tight and a record high price, right? And we're saying, okay, everybody, go build your green economy with pounds and tons of copper. And it's just not there on the shelves, right? So I do believe that there will be back and fill with this trade that, you know, rallies to new highs and then backs off, because when you've got increased volatility like this, we're not going to have a linear path to a new high. Rather, there will be fits and starts. We'll have opportunities like this when the Federal Reserve is actively, what I think, you know, engineering a dollar rally so that they can cool off gold and cool off silver and say, see, guys, we've got the world right. This doesn't look like inflation is scary. I mean, the gold price is collapsing. We can't even talk about inflation with the gold price collapsing, can you? It's very difficult to make a case, believe me. But you can point to the oil market and say, well, oil is 72 bid on the highs and not backing off a dime. You can point to aluminum and zinc, which are still holding their rallies. You can point to the grain markets and, God forbid, the meat markets and say, the Fed's not going to be able to supply that. You know, I look at it and I say the Fed can control the yield curve. The Fed can't sell corn. And so, you know, this is the side of the trade that I want to latch onto. And maybe that's why I sort of choose to stay out of the fixed income markets, Rajiv, if you will. I don't like to be in a position where the Fed can just flatten me like a bug. And I know that that's my risk with trading fixed income and trading FX. So what I do is I put those up on my dashboard as my speedometers. And I sit here and I trade the commodities and the commodity stocks because they're much less susceptible to the Federal Reserve and the jawboning, et cetera, et cetera. So I kind of disagree with the transitory theme. These markets are going steeper in backwardation, which just means tighter and tighter supplies. And the demand is the line for demand is out the door. Whether you want to talk about the demand in form of cyclical recovery of the economy, you want to talk about the demand being the installation of the solar panels and batteries and windmills. What we're doing is we are consuming natural resources from Mother Earth at a rapid pace right now. And that's what you're seeing. I think it's just starting to unfold, quite honestly.
Absolutely. But you know, related to that, there's a question that's come up from Shankar here. So essentially, we are looking at a backwardation in the oil markets. From my understanding of backwardation, it means that the longer term futures are cheaper than the near term futures. That's what backwardation means, right? Doesn't that actually reflect the reverse? Then, you know, people are sort of expecting that the price of oil is actually going to be lesser in the future or the longer term future as compared to immediate. That sort of points to a short term constraint, doesn't it? I mean, how does that agree with what you're saying?
It's very interesting. I always hear people that aren't sort of born in the commodity space that look at a backwardated curve and say this isn't you know, inflationary to me. This is more deflationary if prices go down. But the difference is the way an energy consumer looks at it, a consumer of gas, a consumer of jet fuel, right? When they are about to go fill up at the pump and the pump price is going up, what do? They wait until the last minute because they hope that the price comes down, but they have to pay at the last minute. And so what happens is you have people running for that last minute demand because they need the oil now, right? They don't need to pay up for it in 2 months because maybe they won't need it. Maybe there'll be a reason that they'll need less energy. You know, who knows? You know, maybe they won't have to go. Maybe there won't be trucks going on those runs or rails, you know, rails burning that coal, or maybe there won't be. So maybe we can hold off and only buy a little bit. Also, because not every consumers of energy aren't usually storers, right? You and I aren't going to buy someone it's cheap and store it. You and I go buy it and burn it, right? And so that's why you know, people's energy needs very much becomes last minute accounting, right? Like we covered that energy short position at the last minute because the price is getting away from us. So that's actually how the commodity market prices in that kind of curve, where all of a sudden everybody needs grain now.
Everybody needs coal now. Everybody needs oil now. And so the curve gets steep, saying, okay, we'll put off our buying in the back months for now because we've got to establish this. And so the curves get that way. Inventory gets tight, and it's the exact opposite of what happened when oil prices went negative. Oil prices went negative because merchants that had to take delivery of it had literally no place to put it. No place to put it. So now they're paying somebody else to take those barrels off of their hands. Mm-hmm. And that's when storage was full everywhere. Oil markets were in contango. You could profit by putting floating storage out on the water and earning the roll by being short the oil. Like, these are trades that get blown up when the curve gets steeper and when the price goes up. And so now there's no floating storage out on the water. Seeing, inventory start to decline in heating oil and jet fuel toward the 5-year, the bottom of the 5-year ranges rather than the tops. And so to me, we're setting up for, in the US, $5 gas at the pump is what we're setting up for again, which gets very costly. And that's where it cuts into the wallet. That's where people say, for $5 a gallon, I'm going to sit tight right now.
We're already seeing 100 rupees in the pump here in India. That's a big psychological, level for us, right? So I think that's very clearly there. One more question from Sid. I think, what's your reaction to China trying to cool down the commodity boom? They've been talking it down. They've been putting taxes. They've been trying to raise prices, etc. I mean, they've been trying to raise the barriers, as it were. What do you think is happening there? And obviously, that's reflected in the copper markets. Not so much in iron ore, I'm assuming, in the other two that you mentioned. But what are your thoughts?
The beauty is that we can see China's cards, right? China's holding a set of cards that says the world produces 24 million tons of copper, produces 1 million copper, and China consumes 14 million tons of copper a year.
Could you repeat those numbers again, Tony? We can hear you clearly.
Global copper production, think about it this way, 24 million tons per year created. China produces 1 million tons. They consume 14 million tons. Mm-hmm. So they can say that they're going to sell copper just like I can say I have a full house, right? It doesn't matter what I say. I have got to show you the cards, right? And when they turn their cards around, they are the biggest buyer of copper on the planet. So what can they do as a state authority that can affect commodity prices? They can come out and say, well, we're going to sell our reserves. We're going to VWAP our reserve sales, and we're going to let some copper out into the markets at the end of every month. And then they look at the price and they say, okay, it went down $100. I'm 9,400 bid on the LME. Right? This is literally what they're doing. Like, I know this for a fact because I speak to the traders at JR in London that say China is still buying on the LME. So when you see them saying that they're doing all these things and then you get inside information from merchants, they're on the bid. So I take it with a grain of salt, Rajiv. I really do. I understand that my commodity book is likely to get punched in the nose when they say things like that. But I feel like since I can see their cards, I usually stay with it, and it gives me at least confidence to stay with it or trade around it. That's kind of how I posture that. I really don't look at it as something that is going to be any kind of a brick wall in this commodity rally at all.
So your point is stick around, don't get out, definitely don't short. That's where you are.
That's exactly right. That's exactly right. And maybe that's a little bit of, when I look at the conditions, when I drill down into the commodities, before I take a position, I need to see what my cost of carry is going to be. I need to see what my rollover cost is going to be. And when I look at the commodity markets, it's like looking at a stock that has no borrow, right? It's like, you want to short this thing? Well, good luck, because the whole world that is capable of shorting it is already short. You know what I mean? And so when I look at the commodity markets, it's the opposite of that. It's like, you want to short this thing. There is no commodities around. The curves are steep. The physical side is tight. You can put a short out on a technical position in a chart and maybe pick up a nickel in front of the steamroller. But I think that if you approach this whole trade from, we might be in a 10-year bull run for commodities mentally, that's how I'm going into it. And I play things from the long side, man. There's too much easy money out there. There are $70 million JPEGs trading
You know what I mean? There's so much liquidity out there that being short a hard asset, I can't even get my head around it. I can't even get my head around it. So,
let's switch to something else which is happening. Over the last couple of days, I think that DXY has just shot up to 91.9, and along with it, I think gold and silver have seen serious shocks, right? I think it's at 91.8 now, something like that, whatever it is. 1800 gold, silver, less than 27, obviously that's sort of contrary to what the market has been sort of talking about. And it doesn't seem to be what the Fed said. So what do you think is happening here? The second corollary is a question coming out of that, which is Rajesh's question. Basically, what's your view on equities coming out of all of this for both developed and emerging markets?
I am asking.
Sorry,
could you repeat that again?
Yeah, I am a massive equity bull coming out of it. I really am. There's something I want to share that something really useful that I've listened to very much along the lines of the discussion, and also addresses the first part of the question, which is staying in the hard asset trade. I listened to a podcast with Felix Zulauf and Grant Williams, right? They had a great conversation. Grant is a good friend of mine, a mentor. If there was no Grant Williams, I would not be in business today. So they're having a conversation about the Fed balance sheet with Felix Zulauf, who is a famous Swiss investor, brilliant man. He backs up his views with really accountable evidence and stories and narrative. And so Grant is asking him, where do you think this balance sheet can go, by the time the Fed sops up all of the, securities that it's got to. And everybody's waiting for an answer from Felix Zulauf because he's a revered investor. And he says, I don't know, probably 40 or 50 trillion. Right? Oh. That just opened my mind up. Right? It just opened my mind. Right? Say he could be crazy. Fine. Say this happens. Say at some point down the road, we fast forward and the Fed balance sheet is 40 trillion. These prices on the screen are so far off from what they will be that I think that's how you have to kind of begin opening your mind, right? Say the Fed balance sheet is at 50 trillion. God knows where the dollar index will be. It won't be 92. It will probably be 72. And the price of oil probably won't be $75. It'll probably be $150, right? And so when you think about the potential, this is the path the Fed balance sheet is going. Every time they come to a point where they think they're going to be able to adjust it, like Jerome Powell when he took office and he said he was going to go try to, let rates rise and adjust. No chance, man. First he had Donald Trump stop him and say, for the last 8 years, you were expanding the balance sheet. You're definitely not taking it down on my watch. And so when they decided when they decided after lockdowns that they were going to buy 120 billion of assets a month, I look at the S&P broadly speaking and take a step back from my computer, and it's been very, very straight up since then. So I think that what's very interesting to me, a very good tell for me in equities, Rajiv, cycle back 2 weeks ago when we saw that first huge headline CPI number, right? That generated the biggest tick index sell-off in equities of all time, which means that basically there were more people hitting bids in equities than ever before when the S&P sold off to its 50-day moving average, right? Mm-hmm. A week later, we had the Bitcoin de-risking when it broke through 40K and puked down to 30K. Equities came off again because there was a huge de-risking, right? That was 50 points ago when the S&P bounced off the 50-day moving average. Now we're 200 points higher, right? Or 150 points higher. My point is the S&P continues to prove that it is a massively resilient rally, right? It right in front of your nose, it takes on heavy selling, it consolidates, it stabilizes, and it rallies. And if you were short and you didn't cover your short on one of those 3 episodes, now you're dead again, right? To me, when I'm, if I'm going to think about shorting securities, I like to be able to put them back like I did when I shorted the solar stocks at the fossil fuel bottom and sit back and watch and say, nothing they're doing is hurting me. Nothing they're doing is hurting me. This is following a path. And that is not the case, right? With the equities right now. So
I think it's important to follow that path, to follow the fact that the balance sheet continues to expand. Like we just poked through 80K because at 100, excuse me, we just poked through 8 trillion because at $120 billion a month, you cover some ground, you know, and there has been no discussion of taking off this emergency accommodation. Like I said, with PMIs at 60, with unemployment at 6%, with the S&P at 4K, with yields at 1.5%. I mean, there's no plan to stop buying assets by the Fed. So I'm gonna trade accordingly, Rajiv. And to me, that says it doesn't make sense to be short hard assets or the S&P. You know, the S&P is still there is no alternative, right? When you look at the, I'm sure that credit-based people that followed my credit-based traders that followed my presentation today noticed that I didn't, spend a lot talking about corporate credit or anything like that. But, when credit traders look across the portfolio at yields and at, treasury yields and all the other yields, they look at the S&P and says, this is the best bang for my buck, right? I've got the yield, I've got dividend, and, I've got a trajectory of a rally that is something I can really believe in. So that's why I'm managing to stay bullish equities and stay in the hard asset trade. I hope that explains it in a sort of broad fashion.
Absolutely. I think one element of that Rajesh asked was about developed and emerging markets, but we'll come to that. I think there was one interesting point that you made, which is basically the Fed balance sheet could just explode from whatever $8 trillion to whatever 40 trillion, right? Look, I mean, we've had an experience like this in this world, right? So I think Shankar's point is basically this, that you've had Japan go through this for the last 30 years, right? And it did not seem to sort of hit them really badly. There was not a huge amount of inflation. In fact, the reverse was true. They had a hugely deflationary ecosystem in the nation, and, they just kept pumping it more and more and more and more and more, and they just sort of continued to do that way, right? So why don't you think, I mean, don't you think that could be something that could happen in the US situation as well? I mean, they're not really going to end up with this inflationary story.
Yeah, the forces of deflation are massive. They're still here. But when I look at, the pivots that happened in the commodity market as the Federal Reserve did this, this is an outrageous act, right? This is, 20 years ago, we had a Fed balance sheet of $200,000. There was $200 billion. There was nothing on it, and so changing into this regime of the Fed builds their balance sheet so that equity prices can continue. They're basically sopping up any of the toxic liquidity that's getting puked out of the system and putting it on their balance sheet. So when I don't see a path of this ending, until the Federal Reserve tells me that they're going to stop doing that in some capacity, I can stay with these trades. And then when I see the commodity markets react like they have, and I look at the world and the world is still saying, yeah, we're not really concerned about those commodity prices, right? Because they've been living in this world of debt deflation, of transportation cost deflation, of auto cost deflation, and there are certain deflationary forces that you look around and say, I just bought a pickup truck for $40,000 to replace the $40,000 truck that I bought 20 years ago. So clearly, if I'm spending the same amount of money 20 years later and getting a better vehicle, there is some massive deflation going on, with things like that, and so those forces are real and they play into your pocket just like the other forces do. But when you see the forces that don't get measured by the CPI number, the healthcare costs, the ed costs, on top of all of the other costs rising, I get concerned that we can put, I hate to say hyperinflation, but the situation, the setup is there. The only reason that we haven't probably seen it here is because all of the currency weakness around the world, right? We're seeing other central banks competitively devalue their currency. And that's probably why the dollar hasn't taken an absolute, waterfall move toward devaluation. And it's because, the ECB is building their balance sheet, as is the BFJ, as is everyone else in the world. So, with this competitive devaluation scenario, you never really get that headline inflation because the forces that be are trying to keep it out of the headline number, and there are plenty of deflation to offset it. So that's why they're able to keep yields at 1.5% in the 10-year without anybody freaking out about it.
but I think eventually we're in a phase now where we've seen a lot of commodity inflation, right? We've seen the inflation in commodities, and we're seeing central bankers try to talk it away. The oil price isn't going down. The metal price is temporarily going down. And the gold price, who cares, right? There's nobody in the middle class that cares about the price of gold, right? That's a barometer for the Fed to say we're winning, right? So when I look at the costs of all these things going up and people in the world say that this is temporary, while to me, a look into the curves and into the backwardation is kind of a look into the grocery store shelves. And I can see that those shelves are very thin. And I look around and people don't think that the prices are going to go up. I say, okay, well, what if I buy all the bread on the shelf? Right? Then what? Right? What if I clean the shelf out? Right? Then what are we going to do now? So like I have that commodity trader mindset in me, where I look out and I see people waiting to build solar panels and batteries, and they're in line for copper, and copper is at a new all-time high, and there's no copper on the shelf. So talk to me in 3 months, Rajiv, whether this inflation was transitory, but I'm going to tell you, I'd be willing to bet that the price of copper is $2,000 higher in 3 months. And that's just me.
Wow. Okay. Amen to that. Maybe if you're a copper bull, obviously. So, I mean, I think it's very clear that you're not a bond bull. I mean, you're very clearly not very bullish on bonds, right? It's very clear. Spoke about the 1.5% that the 10-year is at and all that stuff. I think there's a question from Paris which leads into this question, right? So what about, obviously, some people are looking for fixed income as well. What is your view on real estate and REITs as an asset class and asset category? Obviously, the US is slightly different in the sense home prices have just been shooting up in the recent past, right? But I just want you to sort of, perhaps contrast the US versus what you're thinking about in the rest of the world.
Yeah, I have to say, I'm not a REIT trader. Like I don't have expertise, right? I don't know how to carve them up and understand them, et cetera. It's not my wheelhouse. I will say that real estate, it me to express anything but bullish real estate right now.
Could you repeat that again, Tony? Sorry.
It's hard for me to express anything other than bullish in real estate right now, right? The situation locally, Rajiv, if I could just share, is that during the lockdown, the realtors got so busy that they literally couldn't stop for lunch breaks because they were showing houses. People were buying houses. People were buying houses sight unseen to get out of the city, right? So I run into the same real estate broker friend of mine over the weekend and say, are you guys still busy? Because, I look around the neighborhood here and the for sale signs are going up one day and they're coming down the next day. And he said, we're not very busy at all because there's no inventory. So this is another sign of bullishness. Now, I live in a confined area in Nassau County of Long Island, and I understand that this isn't a global scenario, but it's just somewhat indicative of the sort of secular change, right? So now all of a sudden, for whatever reason, there's no available real estate in the tri-state area. This is an eye-opening event, right? So hard assets in real estate right now are bid to the moon. And I think that it's along the lines of, if you have an asset, you're going to be okay, right? If you have a rent producing asset, you're going to be fine in this inflation scenario. And if you don't, think about it conversely, if you don't, your rent is going up and you have no hedge. So these are the kinds of things that play into exactly when somebody says, I can't get my hands on these hard commodities, I can't get my hands on this, but I can buy a building and I can rent it to somebody and generate some income and maybe outpace inflation with that. But that's how I think West. Owning rent out now become where we thought that online shopping was going to kill the shopping mall, and while it has really changed the landscape of physical shopping here in terms of commercial real estate, every place that you think is going to be left for dead gets bought by something else, right? So it's really hard to be bearish anything real estate when you look at that building and say, oh, that building, that was a giant supermarket and nobody goes there anymore, and that thing is never going to get filled. And next thing you know, somebody buys it and 2 weeks later it's a gym.
and you're like, wow, right? Like people aren't wasting time with this empty space here. There is a bid for space, you know. So this is something that I could possibly, you know, I have no problem, you know, investing in the space, the real estate space, you know, hard real estate, whatever you think. That's just to me another play on, if you own assets during this period of inflation, you will survive.
Absolutely. I mean, but the one question on real estate that still comes to mind is obviously, you know, retail has seen, you know, significant uptick in this year, clearly, you know, in the US at least. And as you're saying, you know, real estate space is getting, picked up. But it's also true, or at least we heard that, you know, places like New York and San Francisco, at least the inner cities, their corporate offices have seen a significant reduction in occupancy rates, and hence a consequential reduction in rentals as well, right? You know, isn't that sort of, you know, a trend that's still panning out? I mean, are you still bullish corporate real estate?
Well, so yeah, so this, you know, that's the risk, right? Walgreens closing 5 stores in San Francisco is the risk, right? But what I believe, because what I've been seeing is the rejuvenation, like that has literally, I can't find one case where something that I thought was going to be left for dead wasn't rejuvenated and put back together, you know? So I literally can't think of one case where, you know, even in New York City, right? Like there are big places in New York City, real estate all over the place. All you know is that this place gets closed down, this bank gets closed down, and it gets turned into a restaurant. You know what I mean? So like, I even when Walgreens leaves, you can't underestimate human ingenuity, and somebody's going to look at that space and go, I've got a use for that, right? So while Walgreens may file out, maybe there'll be a rock climbing wall in there. You know what I mean? Like I have no idea, but I'm bullish regeneration, and I'm bullish human nature, right? And human capacity to adjust and evolve. And so, you know, I'm sure that there will be the set of, you know, retail companies that leave New York because, you know, crime has spiked, and there's all kinds of, you know, their stores are doing that as well, and they may leave. But I'm a firm believer that just gets filled in by the next craze, by the next boom, whatever it is. You know, it's impossible for me to get bearish real estate around here in New York even. And, you know, I'm because I'm somebody that was here, you know, the day after 9/11, everybody was like, okay, New York is finished, right? Nobody's ever going to live in New York again. And, you know, if you would have bought a piece of real estate 2 weeks after 9/11, you probably tripled it.
Absolutely. So we have gone about 15 minutes over, Tony. I think it's a testimony to the fact that the conversation is so fascinating. I'm just going to sort of wind down with the last couple of questions. One is from Rajesh. What risk factors do you see to this biggest and the longest bull run? You know, what are the things that could sort of take it down, as it were? So, you know, either in the equities or in the other asset spaces. That's one. I think Jeevan has asked another question about commodity backwardation. You know, is it a turnaround? I mean, do you see a turnaround in the economy, or is it a market shortage that's playing out there? I think those are the two. You know, they're slightly different questions, but choose what you want to choose first.
Okay, so first, the risk. You know, the risk to the reflation trade, to me, is any bout with fiscal sanity. Right? Any realistic conversation about the Fed stopping asset purchases, right? And they've had this conversation. They float the spoon where they can, when they think that it beneficially affects, you know, the markets their way. But the trend is unstoppable toward the Federal Reserve's, you know, consistently building the balance sheet, potentially devaluing the dollar, like is going on competitively with other central banks. So for me, the risk is very low that one of these central banks is going to decide that they're going to pare down their balance sheet. Because what would probably happen is their currency would explode, right? All of their exporters would get destroyed, and it would be an unsettling event. So I more look at it as the risk as if as a whole, central banks decide to stop competitively devaluing, and as a whole, central banks say, you know, this policy, if they have a come to Jesus moment where they say, okay, this policy has been too commodity inflationary, and we're going to have to adjust because people are starving and the price of grains and meat is exploding. I don't see that happening either, unfortunately. So until this trend changes where we're adding 120 billion to the balance sheet every month, no matter what, whether we're recovering, whether we're in emergency, whether the market's selling off, whether the market's rallying, that hasn't changed, right? So to me, that changing, that's the risk to the trade. And so now to move over to the commodity space, I think that the backwardation is developing. You know, there are three things that are driving that to me. There is the cyclical recovery from coming out of lockdowns and getting back into, you know, economic reality that I think will persist. There is the dollar inflation, obviously causing the rush into commodities, but the shortness in commodities is being helped by these supply shortage stories that you're seeing around the world, right? The blockage of the Suez Canal, the US cyber attack on the meat supplier, the US cyber attack on the Colonial Pipeline. All of these things have taken time, but they have panned out to higher transportation costs and higher inflationary scenarios in different markets. So it's being driven by the recovery, by the devaluation of the dollar. And now also on top of it, we're going to have the green movement where everybody is going to need their copper, their cobalt, their lithium for their batteries. And so, you know, when I put that trifecta together, I say, okay, which one of these is going to give in? What are we going to do? Are we going to cancel the green economy? Or are we going to stop adding balance sheet assets? Or is the recovery going to stop dead in its tracks? I don't see any of those three scenarios happening. I'll prepare to address it if it does. But right now, it looks like we're all systems go. You know, and so that's how I'm able to keep a bullish view and a positive view on the world and markets, I think.
Brilliant. So Tony, I think the last order of the day, if people want to reach you or have a conversation with you or get your newsletter, what would they need to do?
Yes, I would love anybody that would like to reach me from this presentation, email me directly, tony@macro.com. I'd be happy to begin a conversation about either the world or my product or anything. My website is tgmacro.com. I have a Morning Navigator newsletter and another package, Slack channel that has about 75 stiff traders in it that talk about taking risk all day.
Sorry, we lost you there. So let me just rephrase that, Tony. I think it's tony@tgmacro.com. If you want to reach Tony directly, tgmacro.com for the website. You also have this newsletter called the Morning Navigator that people can sort of search on Google and apply to it, right? And that's the way they can reach you. You're also on Twitter and on LinkedIn and other places as well, presumably, yes. Right?
Macro.
Ouch, we can't hear you. My apologies. Anyway, so I think we sort of got the big picture. I think what we'll do is obviously I will strip those things and put them into the video when we are doing it. So folks, the video recording will be made available. Thank you so much for listening in. Appreciate all the questions, all of you. And Tony, you're being a rock star. I think, take a bow. Tony Stark, you've done fabulously well.
Makes me happy. I'm really glad that you guys found some value here. This was a lot of fun, and I'd do it for you anytime.
Thank you so much. I look forward to the next session and appreciate your time, which you've so generously given to us. Cheers.
Absolutely.
Bye-bye.
We'll stay in touch. Cheers.